Good morning, 5:35 a.m. Pacific Standard Time, pre-market futures, 5/10/2012. Subject, price volatility increase. Increasing price action both the long side, once again, price volatility to the reversal side. Both the long and short debit combined on an intraday level. As an SMF market maker, you will experience the wholesale and the retail side of exchange models. And when you have a gap up open, which I can show and will be happy to in pre-market on the NYSE right here, I've got MKL up. Okay, so here's some of your listed stocks right here, NYSE. Now that's what that gap open looks like. But on the other hand, the high flyer, what is a high flyer? NASDAQ 100. Let's take a look at the gap open up here. And what is a gap open up? Well, take a look at MNST up 821. Google got a $5 gap for what? Apple 469, 470 gaps, TSLA, but then the rest of them diminished thereafter. It's not like you're having 20 big dollar gaps yet. However, high beta will continue to have the price volatility that you need intraday to ring the cash register several times over and over. So basically, in this particular pre-market, being that it is May 10th of 2012, we already know where all of the counter trends are on all of the indexes, because once again, we'll just kind of visit an MMT. Here, let's take a look at the Dow. Again, when you are in a bull run and you're going to have tops and reversals, this one here, you can see it, just as we had called a short on this Dow, because we did. And why did we do that? Well, because the math was going that way. And here we can take a look at exactly where the shoulder broke. Bam, to here. That's the Dow. And there's your last rally up. This was your counter rally to your first reversal that we called for. Markets were overbought. You come back, bulls counter rally up. And boy, did they. Take a look at that on the Dow. And that's where the Dow is. We already know. You've already had the training on that part. NASDAQ 100, the high flyer of all the high beta stocks in that one particular index, which we are masters at trading NASDAQ 100 call on put options. Here we are right now at 26.21. We're right down here in the pocket. But notice that when we had the original here, let's do this for you. Okay, now what it means is a broader stocks. The stocks make the movement to create these indexes, such as the NASDAQ comp. Now, let's just take a look here very quickly. Once again, here. There you go. And this is all done live right now, I can tell you. So, MMT. We got a weekly expiration on our hands in the option pit, and we're going to have to deal with that. But here's what your support levels are down here. And each day, as it was falling, they were buying names like this. They were buying names like the Apple on the dip. See how Apple, they're using both names in the NASDAQ 100 to support this index electronically. Now, I can't go into exactly what that means, but it's pegged to the price, I can tell you. Not only is that, each part of the week, Google did something good of late, and that is bounce off of that major support levels and go up higher in the price range, as we see right here. But once again, I got to tell you, on the S&P, which I'm going to show you, here now in pre-market. We did this already. We already did this work. So the thing about it is, look, for these indexes to perform, and now look at the S&P. We called that top right here. That's that reversal. Now, I said yes, and these were trend lines that we had on here already, and we broke that one yesterday. We already know that. And you can see where that bottom wick is. It came right in down here at that 1340 handle that I had talked about when we were getting net short up here. And that was your first reversal. And it was a 5-day. Then you put the bottom in and you consolidated the bottom and you broke to the highs where the secondary transaction of shorts are working. Now, what does that mean? It means that, I can tell you, it means that stocks are selling at resistance levels. Otherwise, you would not have the reversal level in the S&P like that. So what does it mean? It means that the broader end of the upper end of price movement in equities are at a wall of resistance, and therefore they reverse. And when they reverse, you sell short and make all that money. But that's what they've been doing. And they're right down here to a major support level. I kid you not. We already knew this when we were doing a short up here. That 1340 is where we would look, because if it breaks this area on the S&P, you got to come on down to that 13. Let's just call it the 1322 area, 13.7, even right above that 1300. Then you're only then you have about a total of 120 point reversal if you break the lows on the S&P, and you have to go down there and look at the reversals now. 3 days. Here's the 5th day. Yesterday it got to bottom. And having said all of that about the indexes, MMT and pre-market, is now we get in and we start dissecting that big mover price line. Oh boy, was that a big mover. Look at it. Last night it got down to 660 and 65. And we were in there buying it. We were shorting it at the highs up there at 728 and after hours, because we were. Yes, we were. And if you want to learn how to trade after hours, we would welcome you. We would welcome you to join us in those activities and how to trade after hours. But once again, we're going to be all over this calls. Get the $700 calls up in there. I've got that price line option tree right here. I'm going to get ready. I'm going to line these bids. And I'm going to line these bids live with the MMTs. And here's what I'm going to do right now on price line and how to trade price line at 710 and where price line was last night and after hours, but how it's going to go up to that major resistance level and say goodbye, because that's where the reversal will come in, MMT. Therefore, that would make that short transaction payable, and the call and put structure on this weekly here and now. Check it out. All of these calls that were in the money right here, like the 710s, the 7, okay, so let's go ahead and put in the 700. We're crying out loud. Let's put in that 690 also. 695. Let's see if it'll take it. 695 over here. Let's see if they steal money out of the premiums here, MMTs. And that's why we're going to do this. Let's just take a look at that 690 put. And let's take a look at the 720 put and the 710 put. Now, these were all in the money puts, and I'll explain that to you in a minute. Now, you can see how much premium 695 call. So they took some premiums out of these. Now, as a master market maker in the option pit, we get to trade these better than anyone else on the street. Better price than anyone else has. The MMTs will have the best price. as we are going to take a look here how they inflate. So I'm going to throw in that 730 put because I'm going to want to see how the price action is going to respond. And we're doing this live. So we will take a look at the 705 call. Remember that these were 705 call was inflated. They were $36. This whole side of this call market, this whole thing right here was inflated in price. And now it's going to come down, and I'm going to get the entries, and I'm going to do it live, and I'm going to do it here, and I'm going to do it now, and it's all going to start in about 15 minutes. Because we're going to get into the pricing controls at that time, MMT, and I'm doing that pre-market future for Thursday, and how the option pit on that weekly is going to respond, and I'll be doing that in that live update on entries and exits. That's where you ring the cash register. Now, let's take a look at the 710 call, and just remember, MMT, that was $34. And we get to buy them wholesale, depending on where this price movement is only $7 or $8 down. So they can only take so much premium out on the opening bell, and then as you go through the day, when this thing shoots back up, because we're long price line in pre-market already. So basically, as this goes up and we're exiting that, we're getting net short up at the high, and we're going to see how much they take out of that 720 put right here. We're going to see what they steal. And what am I going to do? I'm going to put that put right here. 32.50, closed at 30.50. Now, with price line being down right here in the bid and ask, as we see it live, and we know last night by trading it and getting down there at 665, and that thing came down, shot straight down, bounced like a rocket. We have all of those live trades after hours that were done on 5/9 of 2012. Go find them and watch them. You'll learn something from it and what it's like to be here, to be part of this, and what's it like to have the right price action being wholesale, and how they take these premiums out, and then you MMTs get to make your engagement. When price line rolls over, they steal the put. They're $7 in the money on the 720. I have it right here, 720 put. Now here's what I'm going to do. I'm going to put bids out there at $12.70. Yeah. And you're saying, Mario, how could it do that? Well, this is pre-market. That's the last print, 30.50. We're going into the opening bell, and it is in the money. So what? It's how they'll steal the premium. And I'm going to get the entry because I'm a master at it, and I do it live. And I do it here, and I do it now with MMTs. We do the planning correctly. Put bids out there at $12.70 on that 720 put. They steal the premium, you get hit, you make it all day. If they don't make it to that price level and steal that much premium, hey, you don't lose nothing. But if you have the limit order out. And this was at that price level on a weekly now. I mean, it's a 511 contract, okay? So there's the 720 put. Let's get into another one. Let's get into this call, the 700 on the first pass. So here's a $700 call. But now look, it's a weekly, and the high was $48.71, the low was $35. Now MMT, They steal on both sides of the premium. And as they will try, we will put our bids down there at about, let's say on the 700, we'll put our bids, we'll start lining those bids at $20.50, or $21.70, I'm sorry, $21.70 on the $700 call. $21.70, it works its way. $21.70 is a premium level that works its way down to the $15.50 level. There would be different passes at support and resistance in the price volatility that would strip the premium depending on where he wants to open it on the lower end. He could create a market between $21.70 back to, let's say, $26.70. That would be the best case scenario up on that end. Because when he comes back down and he hits that 700 level, and when that price drops, then the premiums will drop rapidly. But you want to gauge the levels in the 1820 by 50 area as the lower support level from a 21.70 back out at a 24.50 market, and you'd be done with the trade. That's how it would work in that top level market. Premium will be cut, and I guarantee you it depends on what side that they want to steal the most from. It's either going to steal the most from the call, or they're going to steal the most for in the money puts without the price having to move very much. And we already have the put option right here, and we already gave bids way down there, $12.70, because they can steal it that way. Now, will they go to that level? If they go to that level, you got markets between $21.70 that are tradable for $1.50, providing on how this bounces that support and goes up and hit resistance. They could run this thing right up, break the high, and if they do, your premium would not come down that much. And we'll visit it in 27 or 33 minutes. And when price, depending on what they do in the bid and ask here, if they cross the market and start buying down here, what do I mean? They start buying this side of the market, they torpedo that up. Say they go 5 pennies above the close, above this price level. They can do that if they buy the ask down here at $13.99, depending on where they open it. And if they open it, who knows? We still have time, but we'll see where we're at, because they're only going to take out so much premium. Now, if they drop these bids down to $6.95 real quick on the open, well, then naturally we would evaluate it, because there's not, you could get down in the $12.50 by $14.60 bid and ask. It just depends on what happens here in the bid and the ask as to what the price levels are going to be. You're going to have upper price levels if this continues to go higher towards $718.95. And on the opening bell, they break it. They break it to the close, then they break the freaking high. They get the shorts out, and everybody ends up all of a sudden getting the puts real freaking cheap. Wholesale, that is. And they pay. So understanding pre-market gap sequences is that you want to do what your price levels look like long before they get there. And it's always going to be based on the dollar ratio of the gap, up or gap down, relative to all of the strike prices. We know. However, they can take a lot of premium out of here. It just depends on where we're at in the upper price range on that opening bell. So MMTs, if they drop it all of a sudden down to $6.97, they calls would go further in price down, because then they could walk away from that bid, or it depends on where they have the opening bid. They could open the bid at 2170 on the open on that call, but then it would only go up after that real quickly if he breaks the high of the day. You know, they're still going to take the premium out of the call. How much will be dependent, once again, MMT, just be ready for those tier structures, because the real tier structure is a market of 2170 marked all the way down to, depending on what the name does between today, Thursday, and tomorrow. We'll see. The price action will settle it. And the premium relative to the gap. So if you're looking at tier level markets, that's how you look at it. And on the put side, we already have bids. And you're saying, well, gee, why are you putting a $12.70 or $13.50 bid or $14.20 out here? Well, because that's where that tier market would be if they stole the premium out, even though that you're in the money. Or they give very little premium, and this premium, they take the most out of here. This premium all of a sudden is going out of the roof, going higher, and this one will come down to the price, to the wholesale price, at some price level. There are different price levels in that one. But this is a high volatile stock, and they can steal all day long. They can do what they want, and they will do what they want relative to where the prices are. Okay? The lower the price, the more they take out of the $700 call. And if they come down toward that 700 level, then that 2170 would be too high of a price. Would be more down in the 1550 range. Because if you break down to that 590, it would be 692 and some change. If they drop the bid down there, that's where they're going to get that call premium as low as they can get it, depending on where this price level is. So that's a special feature for today. And not only that, is how the MMTs are going to get in there and take advantage of it. So let's have a good day. There's the 720. There's the 700.